Hi guys, this is Tim Melvin coming to you from down here in Central Florida on what's been another beautiful day. Of course, I looked at my weather map this morning and that dreaded time of year seems to be almost upon us. I noticed that later this week we're going to have high temperatures that only go into the mid to upper 70s. So probably going to have to break out the longer pants as we get towards the end of the week, and might even have to break into the sock drawer for the first time since last spring. So the big news this week really concerns energy prices, and this came out today. The International Energy Agency said that they really don't see oil prices improving that much. They think it'll be a very long, slow, gradual climb, and not getting up to $80 a barrel until at least the year 2020. That's a lot longer than I think many pundits and investors, and certainly myself, thought it would take for oil prices to get back up to those levels. They think that the Saudis are going to hold OPEC together and actually win this price and market share war by continuing to pump and drive prices down. Now, I read a columnist on Reuters today who pointed out quite correctly that this could actually be really problematic for the United States. You know, we haven't had two down years in oil capex spending in a row in the last 25 years, and it absolutely looks like it's going to happen. We've already got the rig count down quite a bit. Long period of $50 to $60 oils, particularly with all the hedges expiring sometime in 2016, the last high price hedges will run off, is going to be very problematic, and you're going to see the rig count and production levels finally start to take a steep decline here in the United States. If our production continues to drop as a result of lower energy prices, we could become as dependent on OPEC as we were all the way back in the 1970s. And I'm sure you guys remember exactly how well that played out for everybody, the long energy lines and that type of thing. However, there is a kicker in here. If U.S., Russia, Canadian, the higher cost producers are forced into a position of having to cut production, and with the Arabs maintaining and taking additional market share, again, you're going to have the bulk of the oil's energy coming out of a region that is not exactly known for its political stability. So you could get geopolitical events in the Middle East that change the oil price equation very, very quickly. You also have the budgetary problem. We've talked about this. You know, the Saudis are willing to continue to finance out of their treasury by selling other assets this price war with non-OPEC producers. The truth of the matter is Saudi Arabia needs $27 a barrel oil just to break even and to balance, break even on the oil, and the price is somewhere around up $85 to actually balance their annual budget. So they're financing this basically by selling stuff and using up their cash. They're one of the low-cost producers. The producers in Venezuela, Iran, Iraq all have much higher prices needed to balance their budget. So it does become kind of a question, how long are the other OPEC members going to go along with the pain? I think Saudis are committed to this strategy. They're willing to take oil prices lower to feed market share, but it's not going to be an easy process. There are consequences for the U.S., of course, consequences for the drillers, the exploration companies, and the service companies here in the United States, and it's, believe me, more than reflected in the stock prices. The global economy is we're not growing very fast. We're not creating the demand. And as long as that excess production is out there, we could have continued declines in the price of oil. If not declines, maybe just a little stability around this 45 to 50 level, and just a long, slow, gradual increase in prices. That's not a pretty picture for oil companies, but ours do have the financial strength to navigate through the turbulent waters. And as I said, we could always get some type of geopolitical shift that changes the oil price equation instantly. There's also a significant chance that the International Energy Agency is simply wrong, and Europe in particular gets back on track. Demand goes up a little bit faster than they anticipated, and we see $60 to $70 a barrel oil in the next few years. I'm still hoping, of course, we bought a lot of energy stocks last December and have taken a pretty good beating as a result. So we hoping that, Boone Pickens is right. We see 80, $90 sometime in 2016. We could ride it out to 2020. We're certainly willing to, because I think the gains will be impressive, not even just from current levels, but from the levels where we purchased these stocks last year. So we'll see how this all plays out. I kind of think that before 2020, we see geopolitical pressure on oil prices in an upward direction. But as I said, we'll see how it plays out. Been running a lot of screens in the last couple of weeks, playing around with some ideas, testing some of Ben Graham's original theories, particularly the ones from the late 1970s interviews that he did. There was 3 of them in particular where he outlined very simplified methods for picking stocks. Guys, and I know I took the horn on this all the time, but small community bank stocks absolutely dominate the screens that I'm running. These are simple, basic screens based on price to book value and price to earnings ratios, and by far the cheapest sector out there right now is the community banks, in spite of the fact that it's a long, clean runway in front of them as far as the M&A wave goes. Hearing from more and more bankers at various conferences and on conference calls during earnings season, particularly in the $1 to $5 billion range. And they're kind of in the sweet spot of the industry. Okay, they've got more than enough assets and more than enough scale to deal with the increased regulatory and technology costs, but they're not really that close to going over the $10 billion mark, where the extra rules start to kick in as far as fees that they can charge and oversight from the Consumer Financial Protection Board that adds another layer of difficulty and expense to the equation. These banks kind of in this sweet spot have decent stock prices, price to book multiples of 150, 170%, meaning that their stock makes excellent currency for acquisition, and they are on the hunt. And the M&A wave is going to go on for a very long period of time. I talked to somebody the other day. He thought that it would go on until we had less than 1,000 banks. That's like an 80% reduction from where we are now. I don't know if he's right, but I don't think he's that far from wrong either. If you take a look at Europe, for example, most nations in Europe don't have 6,000, 7,000 banks. They have a couple dozen. So we could see that play out in the same fashion here in the United States. And those of us buying these smaller community banks with less than $1 billion in assets, trading below book value, are going to see significant profits. Probably over the rest of our investing lifetime if we play this right. There are no new banks being created. There's not enough inventory to speak of as a result to sustain these banks staying in business. So what's going to happen is you're going to get a $3 billion bank that's going to buy a $500 billion bank, and they're subsequently going to be acquired by a $5 billion bank. This is just going to go on and on and on for a very long time. You get kind of a double compounding effect as book values rise. Remember, Chris Marinac of FIG Partners told us not long ago that he thinks book value growth should average about 7% for the next several years. So in that scenario, you've got book value growing by 7%. Takeover multiples will continue to ease up, and then you're going to get big fish eat small fish, eat smaller fish, and that's every transaction is going to put money in our pocket. So if you're not involved in these, it's a grievous sin of omission that is going to make a difference in your net worth 10, 15, 20 years from now. Now, I've mentioned this in the past couple of weeks. We are raising the price on the second banking publication this month as well. Banking on Profits Monthly is going to go up to $199 a year. That's a really fair price, guys, because you get all the information on the insider and activist activity in the community bank sector. Each month we cover 13D filings, and I have to tell you the returns from those, we measured them from when we started last July up through March. Anything else we felt would be too short a period of time. The returns as a group each and every month is over 20%. Some months have seen 30% returns just over this period of time. And there's been a bunch of takeovers amongst those banks that had 13Ds filed on them by activist investors. You've got a chance to lock in the price for $99 a year for the life of your subscription. Okay, and I continue to plan to continue to offer this banking product service for a very long time. So $99. You get all the insider activist information. This week coming up, we're going to be putting out an issue next week that covers all the 13F filings so that you know everything the bank stock specialist and activist investors were doing in the third quarter of the year. That alone is worth $99. The reading list that goes out every Saturday is worth $99 because it pretty much is an MBA in community bank stock investing. each and every week delivered to your inbox. So hopefully you'll take advantage of it. Sign up. I'll put the usual link in the little description box, and hopefully you'll take advantage of this. I hope that you do. Been reading and hearing talk about the August flash crash. Somebody asked me the other day in an interview, how I fared through the flash crash. I had to ask him what the hell he was talking about. And he said, well, that flash crash in August. So I had to put some pen to paper on this and put some numbers together. Between August 17th and August 25th, the S&P 500 declined by 11% in a week. Now, that's not fun, but it's not a crash, guys, especially when it's happening from 6-year highs. The Russell 2000 was down 9.8%. Again, not fun, but hardly a crash. We've recovered very quickly. We're now back up to just about 1.5% below all-time highs. So a 10% decline, that's a little pullback. It's not a crash. We've gotten really spoiled since the bottoms of 2009 that stocks only go up and every single dip should be bought. Eventually, one of these dips is not going to be viable, and it's going to hurt a lot. So, and this has been going on for a while. People like Carl Icahn, Sam Zell, Seth Klarman over at Ballpost, James Montier of GMO, for whom I have a tremendous amount of respect, and even Warren Buffett have warned this market's a little pricey. And if you look, it's at 21 times earnings. The average enterprise value to earnings before interest and taxes is right around 15, which is kind of high. So the public markets are extended. They're expensive. Earnings growth is almost non-existent. So it's a rough road out there. There's not a lot of bargains. This is a great time to be cautious and hold a lot of cash. And somebody pointed out to me the other day, said, hey, Melvin, you've been saying it for a year. So is Icahn. So is Zell. Well, you know what? If you stepped out of the market a year ago because of these concerns, you haven't missed much at all. If you're buying energy stocks, you miss taking an absolute beating. But the market's only up a couple percent as measured by the S&P 500. The Dow's actually down year over year. So if you stepped out a year ago because of when James Montier wrote his ridiculously or absurdly expensive, whatever he called the stock market, if you stepped out 100%, haven't missed a thing. So it's a time for caution. There's not a lot of bargains. So let's just be careful out there. Much of what we're seeing in terms of earnings, again, this quarter, is financial engineering and cost control. There's been some grievous examples. Stanley Druckenmiller has picked on IBM for using borrowed funds to fund buybacks. But McDonald's this week, today, their shareholder day, said that they were going to return $30 billion in cash to shareholders going forward. And for 2016, they were going to, wait for it, borrow $10 billion to take advantage of low rates to return money to shareholders. They increased the dividend. This is a company that's had several quarters in a row of declining revenues, and it's been struggling to grow earnings at all. The only earnings growth they have is by reducing the share count through buybacks using borrowed money. S&P didn't like that. They downgraded the stock to BBB minus. That's not too far away from junk status for the McDonald's Corporation. So they're cutting back. I think you're going to see a push from McDonald's, by the way, because labor costs are going to hurt them. If all these minimum wage proposals around the country go in, you're going to see ordering kiosks at McDonald's before too much longer if this type of minimum wage pressure does not fade away. Don't think it will. So McDonald's is going to have to do everything to protect their stock price, but this type of financially engineered profit cannot go on. Now, Whole Foods is sitting there. They got $1 billion in cash. Yes, it's a competitive market right now. It's tough. They're feeling pressure on all sides, but Whole Foods is one of the best brands in the United States. Now, I call them whole paycheck because they're a little expensive, but I will tell you, they also have, the meat counter is fabulous, the fish is fabulous. We do occasionally shop there. We're doing like a big fancy prime rib. We always go straight to Whole Foods because they have great products. The company is not growing as fast as the growth stock investors that have been their traditional shareholder base would like. So they announced, they got $1 billion in cash, pristine balance sheet, lots of financial flexibility. Yeah, they laid off some workers, reduced headcount, and they're going to use the $1 billion to buy back stock. By the way, they're buying the stock back at about 19 times earnings, and McDonald's is buying theirs back at 24 times earnings. This is no way to run an economy or stock market, folks. Financial engineering can only support profits for so long. If you That money should be being spent on corporate growth, opening new locations, developing new product lines, or if you really want to reward me, just send me the dividend. I can do better than buying a 5% growth company like McDonald's at 25 times earnings than you can buying back the shares at that price. So way too much financial engineering in the market. Stanley Druckenmiller and Carl Icahn both at the Invest for Kids conference last week waved huge red flags on this. We'll see how it plays out. My prediction is not so good. So we'll see what happens. Not a lot of bargains out there outside of the community bank space. Again, if you're not involved in the community bank space, get involved in it. You're leaving enormous amounts of money on the table. It's not rocket science. Banking on Profits Monthly for $99 a year can help you get started and get you educated in how to uncover and find these potentially winning bank stocks. I get emails all the time from people that take one or two of the services. And I encourage people, and I send out lots of information, the Saturday reading list, other articles and information on how to find these bank stocks and what to look for and how to successfully invest in them. And my favorite emails together was to say, hey, I know you didn't recommend this one, but I was doing some digging and I found this little bank here in my hometown and I managed to buy 1,000 shares and it just got taken over yesterday at a 60% gain. I love that. A lot of money here to be made. Get on it. $99 a year is not a lot of money. Okay, we're in the sports dead zone now. The World Series is over. I can still get excited about Navy and Notre Dame football on Saturdays, but it's not an end-all, be-all for me. And I just have very little interest in the NFL this year for some reason. I think parity has destroyed the game. There's no big evil champion to root against, and it's just not a fun league anymore. So I haven't really been watching it. But fortunately, all the publishers are releasing their holiday book titles now. It's just a plethora of titles to choose from. So I've got a fully loaded Kindle. We'll be watching the debates tonight, waiting for the big chill down here in Florida when it goes down to 75. And I have to put all my shorts away and don the blue jeans. So sad times around the Melvin house this week. Anyway, that's all I've got for you this week, guys. This is Tim Melvin of the Tim Melvin Deep Value Report and the Banking on Profit newsletter service. And I'll talk to you guys next week.